Welcome back to part 2 of our printing business. We left part 1 having completed the balance sheet and being ready for trade. So now we're going to move into the income statement for our first year of trade. So I'm going to put some numbers in here that represent this first year of trade, and I'm going to use some numbers that are kind of easy to work with. So let's assume that the sales in the first year was R1 million worth of sales. So those are printed financial statements that we make for our customer, and they pay us R1 million. One of the things we need to think about is, do they pay us cash on delivery, or do they pay us on some 30 or 60-day payment cycle? And that's important when it comes to the balance sheet a little bit later on. Moving on to the cost of sales. Here, what we're looking at is what is the cost of the materials that go into producing these products that we sell into the customer. And I'm, for now, just going to put in here 300,000 Rand as a representative number for that. So therefore, our gross profit will be R1 million minus the 300,000. We made 700,000 Rand in gross profit. The expenses here are going to represent the rent and the salaries and other overhead costs for managing this business, and I'm going to put in here a number of 250,000 Rand as something that might be reasonable for this business. Now next up is a depreciation expense. So here we need to go and look at these fixed assets. We've got R1 million worth of fixed assets, which consist of two types of assets. We've got a printing press, I'll call that PP, and we've got a delivery vehicle. So the first thing to consider about this, depreciation, because the depreciation expense here represents the use of these assets. It's some cost that we allocate to the income statement using the matching concept, which are those rules that we came across earlier on in the modules. So here I want to ask myself, this printing press, how long is it likely to be operational in the business? And we might have some knowledge of that, but more importantly actually is we need to go and find out some information from SARS, the tax authority, on what they recommend the depreciation time for a printing press should be. And it turns out that for printing equipment it's about 5 years. So therefore we're going to do a calculation in here that says take the 500,000 and divide it by the timeline over which we should depreciate the assets, and that will give us a depreciation expense of 100,000 Rand. Now we can do the same thing for the delivery vehicle, and as it turns out, delivery vehicles should be depreciated over 4 years. So I'm going to say this must be equal to 500,000 because that's what we paid for this, divided by the 4 years, and now we have an expense, depreciation expense for the delivery vehicle. And we can bring both of those expenses in here. We can say make this equal to that one, the printing press plus the delivery vehicle, and now we have a depreciation expense for our fixed assets. Let's work out the profit. Take the 700,000, subtract the expenses, subtract the depreciation. That gets you to 225,000 Rand in operating profits, or EBIT. Next up is an interest expense. And the interest expense relates to the amount of debt in the business. So let's do that under the balance sheet here. And I'm going to put interest here, and let's assume for the purpose of this example that the bank charges us 10% per annum. So we need to calculate what is 10% of the 500,000 that we borrowed from the bank, and let's turn that into a number. So there, 50,000 is the interest expense based on that debt amount. So we can put that in here. we can subtract it from our operating profit in order to get to an earnings before tax. So next up is we need to calculate how much tax do we have to pay on 175,000. We'll take the 175,000 and multiply it by the 28%, which is the corporate tax rate, and now we have a tax expense or tax payable. 175 minus 49 will get us an earnings after tax number. All right, so it's been a good year. We've made a profit at the end of the year, 126,000 Rand. It's a good start to our business. At this stage, I'm not going to get into any complexities about doing ratio analysis to determine how healthy or how profitable the business is. We'll get to that a little bit later on. The next piece is to determine, should we pay a dividend to the shareholder or should we keep all the money in the business? So for the purpose of this example, so that we can process a number, let's assume that out of the 126,000, what if we just said conveniently, let's pay 26,000 Rand to the dividends to the shareholder. That's at management's discretion, of course. And then we will be left with 100,000 Rand in retained earnings. Retained earnings means money that will be kept in the business. All right, so if we're going to keep this money in the business, we better take it over and put it in the balance sheet under the line item that we're going to call retained earnings, and let's put it in there. So what's important to notice here? I want to add some arrows in there just to reflect the fact that we have taken the money from the retained earnings and we've carried it over to the balance sheet, and in fact we have added it to any existing retained earnings because this retained earnings number is cumulative. Now, because this is our first year of operations, we had no retained earnings in the previous year on this balance sheet. So in the first year it will be the same as what's at the bottom of the balance sheet. But in years that go on after this, we will add to this, assuming we make profits in the future. All right. Now we are ready to complete the balance sheet after our year of trading. So what I'm going to do is since we started with retained earnings here at the bottom, as we complete these numbers, I'm going to just add in some coloring here. So I'm going to paint this cell green just to remind us that we've processed it. And by processed it, I mean I took it to the balance sheet and I showed the impact that it has on the business. And I'm going to work my way up through each of these numbers. And I'm going to show how these numbers need to be processed so that I can update the balance sheet to reflect the new balance sheet at the end of the year. Because of course, there are a few key things that have changed. Our cash position is different. From the beginning of the year to the end of the year, we've received money from customers, we've paid money to suppliers, etc., and to employees, and we need to recognize that there's a change in cash. We've also used up stock, which has obviously been given out to customers as part of a finished product. We've paid some dividends, we've paid some taxes, we've paid some interest. All these things have an effect on the business, and we need to represent how they show up. So let's move to the dividends. So this is a payment that's made to shareholders, and of course you can only make this payment from the cash that's in the bank. So I'm going to come up here and I'm going to say make this cash equal to the starting balance. How much did we have when we started our business? We had 250,000, and I'm just simply going to process through the cash account these series of in and out payments that happened throughout the year. So let's start with the 250, and from there we will subtract the dividend payment, and now we can paint that green to say we have processed that. The earnings after tax is simply a subtotal, so we don't need to process that. We need to process the tax amount because we paid that to SARS, so we must subtract the tax. And we can paint that green to say it's been processed. The earnings before tax is a subtotal, so we don't need to process that. The next one we need to process is the interest payment. We paid that from cash. You can only pay interest out of the cash in the bank account. So let's subtract that out of our cash and paint that green to show that we have processed that. Next up is EBIT, and that is a subtotal, so we don't process that. So now we're going to move on to the depreciation. Now depreciation is defined as a non-cash expense. It's not money that we pay to anyone. It's an expense that we allocate that represents the use of these fixed assets. So to put that on the balance sheet, we need to show that we started the year with R1 million in assets, and we used these over the year. And by the end of the year, these assets were now valued at R1 million minus the depreciation, which gives us 775,000 Rand. And we can now say that this has been processed. Next up, expenses. So these are salaries and rent expenses, and these get paid out of cash. So we must subtract those from our cash account, and we can paint this green. All right, so next up is our cost of sales. Remember, this cost of sales represents stock that we used in the production process. Now that stock is already represented here on the balance sheet. We already processed the cash implications of the stock when we were setting up our business. So now what we need to do is this 300,000 Rand needs to come out of our stock amount. So on the balance sheet here, I'm going to create a stock item where this consists of 250,000 plus that 250,000, which is the amount of stock we had at the beginning of the year. And from that, I am going to subtract the stock that we used to produce the products that we gave to the customers. So our stock levels have gone down. We have less paper, we have less ink, because we've printed that stuff for the customer, and now we have processed the 300,000 Rand. And what's left is the sales amount that has come in from our customers. So let's assume for now, let's start off by assuming that this is paid to us in cash, because that makes it nice and easy. That means we can come here and we can simply say add to our cash account this R1 million. There we go. And we can paint that green, and we can say customers paid us, and our final cash position at the end of the year is 875,000. So a few other bits and pieces we need to tidy up here, because of course we still have this equity from the shareholder that's still in our business. We still owe the shareholder R1 million. It's a liability on our balance sheet. It's part of our capital. So let's do a quick sum here just to calculate what's our total equity. Let's call it total E for now. Sum of those two, that's shareholders' money. And we need to represent the fact that we still have 500,000 Rands worth of debt on the balance sheet. Now we have paid 50,000 Rand in interest payments. That's for the use of that money, use of the debt, but we haven't repaid any capital yet. And we're going to talk about that in a moment. So on the total capital side of the balance sheet, we can now say we have equity plus debt, and there is our total capital number. Now hopefully in a moment when we do our calculations on this side, we are going to get our net assets to be 1.6 million as well. So far so good. We've got cash, we've got fixed assets, we've got stock, we've done all those calculations. There's one item that we haven't done, and that is that money we owe the supplier. Alright, so it turns out we've got to the end of the year and we haven't paid them. They might be a little grumpy with us about that. So we'll have to sort that out shortly. Let's do a sum calculation here. Ask Excel to add those up for us, and let's see what comes out at the bottom here. Well, that's fantastic. 1.6 million is the amount under the net assets, and look at that, it balances with what's in the total capital. So now we've completed the balance sheet for the second year. There's a few bits and pieces we need to tidy up here, but I'm going to pause this video here and I'm going to move those tidy up things and wrap up and summary into part 3. See you in the next video.